When it comes to retirement, superannuation is more than just a savings account. It's the engine that powers your future lifestyle.
Super would be people's second biggest asset after their home. It is something that they should really look at. They should really pay attention to it, care for it, grow for it. It's a long-term investment. The sooner you start, the better. You don't have to wait till retirement to go, I'm going to do something about it. You got to start early. You got to see an advisor early on.
In this episode of the Wealth Guide podcast, we unpack the ins and outs of super. So how to grow it, how to protect it, and what to actually do with it when the time comes to retire. So we break down the common myths, key contribution strategies, and how to make the most out of your compound interest. Plus, what to watch out for once you hit retirement and start drawing it down.
I had a client that was 21, 22. By doing simple things of putting a decent investment structure in place, having a cost-effective fund, it made a difference of an extra around about 800,000 at retirement.
Our advice is for different life stages. We cater from people starting out, first home buyers, first time investors. We see that as part of their journey.
Whether you're in your 30s or in your 60s, this episode is packed with practical insights to help you turn your super into real, sustainable income for life. Because let's face it, when it comes to retirement, it's not just about getting there, it's about thriving when you do. So hi everyone, happy Wednesday and welcome back to the Wealth Guide. Jack, nice to see you. I think I've seen you in a while.
Yes.
Absolutely.
Is it Wednesday?
It is Wednesday,
it's
right?
Friday.
Okay, cool. Ricky, how are you?
Well, thank you,
You made
Mel.
it?
I did. It's been a while.
Did you get a visa to come over here?
Yeah.
Good job. And for those of you that don't know Dean, welcome Dean. Nice to meet you.
Thank you. Thanks for having me.
Anytime. So today we thought we'd have a quick conversation since I'm here now and I'm getting near that age. What happens to your super when you retire? So heaps of questions. Firstly, things that I don't understand about super and things that I don't understand about when we're going to retire, as probably most people don't. Today we thought we'd just kick off with a couple of quick questions. So I guess first of all, assuming I have super when I do retire, what happens to my super? Like, do I keep it invested? Do I draw it down? Do I have to manage it all by myself? So, what happens to it? Do I have to withdraw it or can I leave it there?
Government takes it, Mel.
Government takes it. Okay.
Or some people that they go to a Swiss island and spend it there.
Oh, I was thinking more of a Caribbean. I'm a bit more of a Caribbean, right? Yeah.
Correct.
I only want winter at Christmas.
Yeah. Makes sense.
Cool. But no, so, a lot of us are sort of nearing that age. Super, I guess, we're sort of coming into that. Would you say the second round of people hitting in that super age at retirement from when super was first initiated? I know that I'm a bit older than a few of you here, so not so much you, Jack.
Yeah, you told me a few times.
I do remember starting work and super was a brand new thing, right? So even when I was starting work, not all employers actually gave you super. It hadn't even been made compulsory yet. So I am showing my age. So but on a genuine note, like when we do get to retirement age, do we have to withdraw it? Do we manage it ourselves? Like what happens, guys? Or does it convert?
Look, it ultimately would depend on your situation and circumstances. The whole purpose around the super side of things is to help fund part of your lifestyle living expenses. What I've come to see with a lot of clients, a lot of the time the age pension, so what Centrelink gives us is usually not enough. So the super fund is there designed to help cover the difference.
Yeah. So at retirement, I can have super and still get a pension?
Of course.
Okay. Oh, good. All those years
Legally, yes.
legally. Okay, so all those years of tax paying will come back to me.
Correct.
Okay, cool, excellent. Do you reinvest your super, or do you have to convert your actual super into a pension? Like, how does that work, guys? Ricky?
Well, Mel, super would be people's second biggest asset after their home. It is something that they should really look at. They should really pay attention to it. They should really look at, care for it, grow for it. It's a long-term investment.
Yeah. So
it is something that people tend to ignore. And people go, I don't know what my super balance is. I don't care. I can't withdraw it. I can't do it. Yeah. It ticks in the background. And which is also a good part about it because the whole compounding and everything, compound interest and everything comes into play. And which means over the period of time, when the people retire, there's a bigger balance available for them to live on.
And you know what? You hit the nail on the head, though. It is so true. Like, I'm guilty of it, and I'm sure, a lot of people are guilty of it, is your automatic super payments go in and you literally think nothing of it. You're like, it's just there. It'll be sufficient. It'll be okay. I guess that then leads to my next question, which is, in the office, I hear you guys talking with clients, and some of you sound more educated than others, which is fantastic. So I hear the phrase getting thrown around about super remaining in accumulation or super going into a pension account.
You're right, Mel. To Ricky and Dean's point, our job is you hit the nail on the coffin, that education is a key piece of our job. We're almost like teachers, pretty much, in the day, educating that client. Say, accumulation and pension that's our world. To you, it might be an alien word.
Well, it is, actually. It is.
So
I mean, if you said Chanel or Dior,
yes,
I would understand the difference. And if you compared Chanel or Dior to Target or Big W,
exactly.
I would understand the analogy better.
So the education piece is quite important for us with the clients. It's day-to-day for us. But at the same token, how do we partner that with what's important to the client? Yes, accumulation and pension. How do we translate that in our world is, well, accumulation is we're going to get to the permanent holiday over a period of time.
Yes, that's me.
So typically people understand, that's my holiday bucket. And then what happens at that point is we kind of build that long-term
Well, that's
holiday.
the analogy I use too with my clients. Probably not the holiday one. I might use that, Jack.
Ricky's way too conservative. He'll be using really sensible words like stocks and bonds and, retirement villages.
How I use it.
Villages. Yeah, it's a whole different topic. Right?
Exactly.
Well, how I explain it to the clients is like it's a house and you've got a living room and a kitchen, dining area, or kitchen room, right? So what you do is when you are working, you are in the kitchen. So everything comes in, you're preparing your meal and everything. And in retirement, you move it into the living room to have your dinner. Right. So that's where it's like your accumulation is your kitchen, if you will. So the money comes in, but you can't come out.
I'm in trouble because I'm already eating in the lounge room. Like serious trouble. I don't know what any of that means. Okay, but that's actually, I like that. That's how do you explain it to your customers, Dean? Because you have a different lens.
So with myself, it's more about accumulation phase is basically trying to build everything up and get them ready for their retirement phase. And then the pension side is obviously living whilst in the retirement and just drawing that income stream to make sure that they've got enough money there to sustain their lifestyle.
So the income stream, really, I just call it, is a replacement of you. That becomes your employer really.
Yeah, the income.
Okay.
Definitely.
So if you're working, if I'm working for you, see you later, lady boss, and then I turn my
You are never leaving me, Jack, ever.
I'm going to go to Bahamas. That's my pension. That's what
right. Okay. Yeah. All right. And so, obviously through our working careers, we all complain about paying tax. So on super, and again, I know there's different rules for different things. How are they taxed? So accumulation, is that tax-free? Is pension tax-free? Are they both tax-free? Like for most of us, we don't know how this works. And again, it's a world that if it's your specialty, you understand it. And for most of us, we just leave it sitting there and we have no clue what's going on. And one day, all of a sudden we're like, oh, okay, bang, here's our super. What does that all mean? So how does the tax part work on accumulation versus pension, and is there a better option for one or the other?
Look, I'll jump onto this one. I had a conversation with a client quite recently, but whilst your super or your funds are sitting in accumulation phase, you're taxed at 15%, which is a super rate, right? Now, anything that goes in there, anything that it makes, a lot of the time, you're taxed at 15%. Now, once you're over the age of 60 and you declare retirement, anything that we'll make at that pension phase is completely tax-free. Right. So any income we draw out from it, any investment returns that it makes, it's completely tax-free. Now, it's such an intricate and very important part because when you're at that retirement phase, we need to stop any form of bleeding that we've got so that our super there can last us as long as we possibly can.
Okay. So for my understanding, just to make sure I've got this right, in accumulation, it's essentially anything going in and building that wealth as it's growing, we're all taxed at 15%.
Yep.
Then once we hit that retirement age and we're drawing out of it, the super balance itself is no longer taxed, or just the drawings are no longer taxed? Or the whole thing?
The earnings and the drawings as well.
Okay.
From a tax perspective, you're paying a real estate agent to get to that holiday, yeah?
A real estate agent to get to the holiday.
Travel agent. Travel agent.
I'm not paying a real
Travel
estate
agent.
agent
Unless you're buying
anything.
a house there.
Exactly.
Yeah, so accumulation, you're paying the travel agent for the fee because you want to
Okay.
enjoy the holiday.
So like a service fee.
Correct. But from pension or your own pension fund, you kind of know what to do now. You're going to go on your own holiday. You don't need a travel agent anymore. So no more tax.
Jeez, you give us way too much credit. I think I'm going to need a travel agent forever.
Well, Mel, and that's the point, right? Our individual tax rate could be a lot higher, right? If you're earning over 180,000, we'll be paying 47% tax, for example. But super in its tax structure is so effective, it's such a good investment where any earnings are only taxed at 15%, which makes it very attractive for people to put money into.
So that leads to a really great question. So you're right. I'm thinking of 15%. I think I wish I was paying 15% on my income tax. I mean, and let's be serious. The rate of money that you guys are paying me right now, probably pay less. I'll be at 0% because I'm earning in peanuts. But let's assume I'm earning a bit more money than that. Is there a cap of how much I can contribute over and above the amount that as an employer you put in that I can contribute? And is that an age dependent thing?
Absolutely. Well, look, government, although they've made it attractive, they're also restricting in a way, if you will, how much money you can put into super. So the cap limit in anyone who's working is about $30,000 a year.
Okay. Regardless of income level and regardless of age.
Exactly. And then it also depended on how much your employer's already put in. So it's not a personal, I can't just take 30,000 from my bank account and put it in. For example, if my employers have already put 20,000 in the year, that only leaves me with $10,000.
Oh.
Yeah. So I've got an example of that, guys. I saw a client 2 months ago. He's been putting extra money into his super fund, not thinking the employer accounts for that maximum. Lucky I saw him. I said, mate, I looked at the thing. You're going to go over this in the next 2 months. You need to stop or else.
That's really interesting because you would imagine that, and I guess that then leads to really people should be seeking financial advice and having a financial planner.
Yeah.
Because if you're innocently doing that, and if the super fund's not rejecting that deposit
Correct.
when it hits its cap.
The intention is great. He had a great intention, but didn't know rules around it.
Yeah.
And I told him, you're gonna get a love letter from the ATO.
And you can't really blame the super funds too. Look, I've got to take their side for once. It's because people have multiple supers.
Correct.
So if super fund A cannot keep track of what super fund B is getting, right? So if a super fund A is getting employer contribution and I'm putting my money into super fund B, they don't talk to each other.
No.
Okay, so now I'm thinking. So so the $30,000 cap, is that per super fund?
No.
Oh, okay. I was thinking, yes, I'm going to go and get a few more funds. Okay.
People have tried that, Mel.
Yeah.
Oh, okay. Are they still here to tell a story?
Well, I have heard about that's what, going back to Jack's point, I had to go a similar situation for another client because they had multiple super funds. They were contributing into fund B, not knowing the employer's also putting money into fund A. And it's a similar situation what happened.
But one of the key things as well you need to be very, very careful of is the moment you tend to go over that cap, the tax implications is 45%. 40 on any excess contribution.
Is that right?
So you go from trying to be on a safe haven of 15% tax rate to as high as 45. So
going, I made a big mistake.
Correct,
And welcome to the ATO.
correct.
Okay.
The government's going to love you there, and they've just got some extra money, right? But
You get a love letter from the ATO. Hey,
that's right.
We need to see you.
That's right.
I've actually got a few friends that work at the ATO. I'm hoping of avoiding a letter. I guess then, we speak about the accumulation and putting money in. What about when it comes to taking money out? Like, is there a stage that you can start drawing down, and do you have to be retired to start drawing down? Like, is there a minimum age?
Well, generally speaking, accumulation is designed, like I said, it's your kitchen where you can only put money in. You can't take it out. In accumulation, you can only put money in. Generally, you can't withdraw the money. There are rules around it. You look at like financial hardship, medical purposes. People have withdrawn money, so you can. There are rules around it, but generally speaking, you can't. And then when you turn it into a income stream or a pension, then you can't add money to it. You can only draw money from it.
So, for example, what is the retirement age for a man to a woman now? Is there a legal age now?
Yeah, look, there is. It's around about age pension age. So age pension age is where the age that the government will say, look, you meet age pension age and we can give you a pension, which is around about 67.
Is that for men and women?
Men and women, yeah.
We work way harder than you. Ours should be
before.
like 45.
It used to be very different before.
See, this is the misconception. Clients, people think, I can only access my super at 67.
Which was leading to my next question,
They're
right?
thinking that super, they link it to the government age pension.
Yeah, correct.
So the age pension access
different.
is 67. For us to access a super,
It's 60.
it's a 60 generally speaking.
Yeah, because what I was going to add to that as well, because I think part of the question was, when can you really access your super? So you can actually start accessing it at 60, and you can create something that's called a transition to retirement pension, where basically whilst you're towards the later end of your working career, you can access up to a maximum of 10% of your super balance, and then you can use that for other things. So for example, traditionally speaking, some people might start dropping hours at work and they use the super to substitute it. Some clients might be using a part of the super money there to continue to pay down their mortgage. So there's so many strategies that can be done
But when you say the 10%, sorry, forgive me, do you mean in a lump sum or as a weekly wage?
You could do either or. We could structure it as a lump sum. You could structure it as a weekly income. Depending on the situation and the circumstances, sometimes it's okay to give a lump sum, but you don't want the client to actually, you wouldn't want them to blow it, basically, if they've just got a big lump sum
What's
of
wrong
money.
with blowing it?
Right?
It's like red or black, right?
To Dean's point, I've got a client, as an example of that. Got a client that used to be an engineer. He said, I've been working for 40 years. I'm tired. Is there a way for me to slow down? And I said to him, what are you going to do if you slow down? He said, I like to fish and play golf. Can I do that, Jack? I said, how often would you do that? Well, maybe twice a week. So I explained to him what Dean said. He reduced his full-time work from five days a week to 3 days. So his income's obviously dropped a little bit. So for us, the strategy is to get money to bridge that gap of those 2 days.
Okay.
Happy days. He's still working to some capacity. To Dean's point is he's able to enjoy the golf and fishing.
Well,
So what I'm taking out of this is I need to start having golf lessons.
Well, and I say a similar thing to my client too. I do say, well, look, to your question, Mel, when can you retire? You can essentially retire any time.
Yep.
But do you have financial means to support yourself? So generally speaking, after age 60 is when people can access super. 65 means you can have full access to super, and 67 is the retirement age. So I think because the age pension has now moved to 67, people are now relating that as a retirement age. But
Correct. That's a common misconception. Yeah. So when people say, I'm a self-funded retiree, they're funding themselves from 60 to 67.
And is there a cap on your super versus pension? Or for example, let's say, which I am not, but let's say I was really smart throughout my working career and I had $4 million in super at retirement age. Are you then still eligible for a pension?
are you talking government pension?
Yeah, the age pension.
Oh, the age pension. Oh, absolutely. There is a limit. I think it's $1,059,000 in assets. Before where it cuts off.
And when you say assets, you mean cash assets? Or?
Yeah, it does not include home,
right?
Generally, unless you're on a big farm, then it's a separate issue. But age pension, it's asset and income tested. So just because you worked and paid taxes throughout your life doesn't necessarily mean you'll be entitled to age pension.
Yeah, so
in short,
there's a lot to
the government's
navigate.
not going to give you money until they assess you.
Which I like. It's fair in a way. Like it's to say that it's there to support people who need help. Just because I've got $5 million in super or in assets overall, I don't necessarily need support from the government.
And you'd still be able to have a very comfortable lifestyle as well.
Correct.
Which I think a lot of people misunderstand.
And on the flip side,
I'm thinking Bali now. Maybe that's my budget.
Because the funny thing is, and I see this happen all the time.
Oh,
where
here we go.
Clients but it makes me laugh because you've got clients who might have money, and they've probably going to be over the cap, but they're like, okay, well, look, I'm going to start giving away all my money to everyone so I can get the age pension. And you go from having a couple of million to getting an age pension of $700 a fortnight, $800 a fortnight.
Just to get $14.73 per fortnight.
It doesn't make sense.
Yeah, absolutely. Absolutely.
I guess it's that, mentality. Hey, I've worked for 40, 50 years. Yeah. I had a lady, this was years ago. She said to me, Jack, I don't give an F if you give me $1. Just get me an age pension.
It's the pensioner card.
But genuinely, some people feel like it is their entitlement at retirement after working. Correct. For most of us, we pay so much money in tax and it's like, well, what circles back? But we do forget though, I guess that's why you need to be smarter through that journey, because a lot of countries don't even have an age pension.
Correct.
If I'm not mistaken.
Circling back in what the client needs, in our job, I guess, to educate what there really is important for them, not because they want to get age pension as well. So.
And this is also the education part comes in, that when we sit down with the client, we talk about it. So if you are over the cap limit, there are investments available which you can bring down to a certain amount where I had a situation where the clients weren't eligible, but then after we worked through them, they are now eligible. So there are rules and things you can do, not breaching the rule, you still be eligible for age pension.
It's all about structuring.
It all comes down to education, working with your advisor and making sure that you meet your objective.
Do you guys know any good advisors?
I can tell you one, Mel, just sitting right here.
You're in your kitchen cooking though. You're busy.
Hey, you explained that I can see an apron with no clothes.
Listen, this is a PG podcast. PG.
Sorry.
All right, let's keep it above the waist. All right, but speaking of in the kitchen and cooking,
He's got a visual now.
Dean's blushing. Get
that picture out of the mind. Come on.
Dean's going to buy an apron on his way home. Absolutely.
He started the analogy, sorry.
You're actually blushing. Asian flush going on. I love it. What are we cooking, just by the way?
What do you like, Jack?
I hope it's nothing with oil products. Nothing with oil.
Sausage and egg.
Oh, dear. Okay. All right. Okay.
Oh,
All right. So speaking of sausage and egg, or the chicken and the egg, whichever one we want to use as an analogy, I guess this another question that I would ask, and I appreciate this because it's actually a full education session for me, and I feel like even though I've worked in finance for 30 years, more actually, I'm showing my age truly, the world of super, how it works, what we do with it, how do we create that wealth and have a comfortable lifestyle at retirement without panic is really a grey area for most of us. So, and you're right, circling back to what we were saying before, most people just leave things sitting there and just go, okay, it'll trot along and it'll all work out. It'll figure itself out, or I'll live in a granny flat in my kid's backyard, one or the other.
Ricky mentioned a few times the education piece. Super is one piece of the puzzle that we do. So that's why it's important to look at everything. Yep.
Absolutely. So, we speak about drawdowns and having a wage out of your super. I think that's what we're referring to it as. Is there a benefit or a reason that you would do it in a different cycle? So, for example, we get paid weekly, fortnightly, monthly. Is there any perks or like pros or cons to doing one to the other? Is there different implications to any of the frequencies?
When drawing money out of super, look, it depends on client situation. I would talk to my clients, understand what their needs are. If they are someone who would spend the money as soon as it hits the bank account, then we would be like, okay, let's draw it, in fortnightly payments. Yeah. So it turns into like your wage payment. I've also got a client, you won't believe it, just a couple of days ago, we've decided to not turn it into pension because she said, I'm happy to live on my age pension right now. I don't need extra money. I want to use that for either for my nursing home or for my kids later on.
So you can actually do that. You can leave your money in your super. If you're in that bracket of people who your super is, it's a nice little nest egg, but it's not enough to not get an age pension. So you're eligible. You've paid just the right amount of tax and the right amount of super that you still get your entitlement of age pension. So can you physically just live on that and leave your pension in there? And does that remain in accumulation? And by doing that, and I know I'm asking a lot of questions because you raise really good points. So living on an age pension, leaving your super intact, the question is, does it still accumulate and do you still pay tax on that even if you're retired on an age pension?
So that was the conversation I had with my client. I said, well, look, you understand if you move it into a pension or an income stream, you have to draw an income. You cannot say to the government that I don't want to draw a pension. You have to. And that's dependent. The minimum is dependent on your age, obviously. So it moves in age brackets. But we purposely decided to leave that in accumulation so that she doesn't have to spend it. Going back to your previous point about taxes, that was the conversation we had with the client.
Yeah.
We can leave it in accumulation, but client, you do understand that, you would be paying 15% tax on your earnings sitting in accumulation.
So you'd really have to look at your super fund and go, what makes sense to have a minimum drawdown where there's no longer tax?
That and to Ricky, to tailor that plan for that client.
Yeah. And how do you, I mean, I guess that leads to my next question of tax implications. So you've got your age pension, you choose to leave your super intact, you're paying the 15% on that accumulation, but would you then have to visit what is the return on that? Like which one weighs up better?
Absolutely. You sit down. That's hence we sit down with our client at least annually to go through and review their situation every year.
Yeah.
And it is so important, Mel, to the point that you raised, is just analysing client situation and working out which course of action is better for the client.
What gives you the greatest wealth option?
Absolutely.
Yeah.
It may be better to leave that in accumulation right now, but it could be mean that, okay, next year we change the strategy a little bit different.
Because it'd be the return on your investment on your super fund, surely.
Talk about return on investment, it's how you invest it. So it could mean when you're accumulating, you might be willing to take more risk with your money by having it more in shares and property. But when it comes to retirement, then you sort of dial that down a little bit to go, okay, I don't want that much shares just because market volatility also plays a part.
Yeah, absolutely.
So you just bring it down to go, okay, what's your acceptable level of risk right now?
Yeah. And I would imagine the benefit having someone like yourselves managing that and having that review, you can sort of determine at what age do you start doing that high investment funds and, more riskier. And when do you dial it down? When do you dial it up? So I'd imagine there's age dependencies that go around it, market dependencies that go around it, and I guess also tax implications, right?
Yes, all those things are important. But Ricky and Dean's point is we start to really to the basics, what does client need? What the cash flow needs are.
I need a European holiday 6 months of the year chasing summer. That's what I need.
That's it. We can work on that.
We'll talk about that in another podcast.
Exactly.
Holidays. So one of the things that I've heard people talk about, and again, this is not my world of expertise. Let's give us a few podcasts in 6 months and then I won't need any of you here. It'll all be about me. Defined benefit super scheme. What is that?
It's a golden goose of super fund.
Well,
not available anymore. You can't have it. People who do have it, we generally say to them, retain it. How defined benefit works, I'll compare that to accumulation. When we are working with putting money into super, and defined benefit is similar in a way where the money goes in. However, the end result is there's a formula of multiples. So it depends what client. With accumulation, we know what our balances are, right? But with defined benefit, you really find out at retirement what your real balance of.
Is it like a lottery ticket?
It really is in a way.
There's a degree of guarantee.
If you want to put gambling. Can you use gambling and super in the same sentence?
Because it's based on your final salary, how long have you worked with the employer, and there's a multiple factor. So times, and the super balance just balloons up to a much higher sum. So it's a great scheme to have. But unfortunately, government did some sums. They realized Treasury can't support paying people for their life and reverting to their spouse when they die. They decided to not have defined benefit anymore.
Oh, okay.
So defined benefit really, in my eyes, is like a luxury boost of super fund, like on steroids, if you want to put it that way.
So for my understanding, correct me if I'm wrong, and I'll look to you, Dean, for this. In our lifetime, we won't have it, but a defined benefit it's like that. For example, you get to retirement age, you get a defined benefit every month of, let's say, 20 grand. God willing, you live to 90 to truly get the benefit of it. But then when you pass, there's no longer a balance that you can then inherit to your family.
So I think, and I'll just take you back. I think just to keep it a little bit more simple for everyone, the difference is with accumulation phase, it's what you've saved up throughout the years. Okay. And then whatever we have at the end, that is what your super balance is going to be. Whereas with the defined benefit structure, it's like Ricky was saying, it's based on the multiple and all that type of stuff. But what ends up happening is it also works as a guaranteed amount that you would have receive as a pension or as an income until your life expectancy. So the market could be doing really, really well, doesn't change what we get. But even if the market tanks, you're still receiving the same amount. Okay. So it's a lot more, just think of it's like a lifetime employer with a lifetime guaranteed income.
But it's no longer available.
It's not like Kilo Lotto where you win for 20,000 for the rest of your life.
Correct. Yeah.
That's what is it, Kilo?
Yeah, correct.
20,000 per month for the rest of your life.
Correct,
so defined benefit is something like that.
Yeah.
Well, it's interesting though, because I've taken a different view because again, it depends on the client. So defined benefit, you accumulate, And at the end of the retirement, you have to make a decision. Do you want to get a lump sum?
Correct.
Or do you want to get an income for life? Or there's also hybrid where you get a little bit lump sum and a little bit income for life.
And why is it not available anymore? Because of Treasury.
It's a big impost on the super fund.
It's not sustainable.
So is anyone going through the superannuation thing on that benefit that will still get it, or it's just ceased? As in, once you now go to retirement age, you're no longer able to have that as an option.
Some people at the moment, still have it. And whenever we see clients with that, we always say to them, look, this is a great structure. Never ever make changes to it. Leave it as it is. But
we do come in at the later end when they're about to think that Ricky said, what are you going to do, lump sum or lifetime? So we plan for that. But generally speaking, if they're like, I've got a defined benefit, they're 40 years old.
How do you know if you have a defined benefit though? Like genuinely, like I've got a couple of different super funds. I probably need to speak to a financial advisor on a very serious note.
It's like you seeing a bag, it's for Chanel or Prada, right? It's probably the same thing.
No, but like, circling back to what we spoke about before on a genuine note, so many of us have super where it's just part and parcel of what we have, what we do, and really don't think about it.
We do check it.
How do you know, like as an individual though, how would you know if you have a divine benefit?
Generally speaking, clients don't know that.
That's right.
It's just they don't know what they have. They just know they've got a super fund. And generally speaking, if you work for the government and you've been working there for a long period of time, you would have a defined benefit.
Okay, so it's mostly government type employees that have it. So the average mere mortal like ourselves, we would never get it as a generalisation.
People who work for Telstra, Post Office, Qantas,
Aren't they government?
Big banks.
Not anymore. They were. They still act like one.
Act like one.
Okay. And last but not least, things like lump sums, rollover, guaranteed index pensions. These are all words that I hear flying around the office. 1, 2, 3, lump sum, rollover, guaranteed index pension, only because you're closer to that age group. Give me a quick rundown. So lump sum, explain that to me.
It's pretty simple. It's a lump sum, right? So a lump sum pension is basically, just the total balance, and it's obviously what you've accumulated and so forth, and you can draw it out as a lump sum. So you can take all your super out. But what I always say to people, it's very, very important because some people, I'm going to go into a little bit of a story.
Yes, please.
Okay.
Stories are good. I understand stories.
This happened to me literally probably a week ago. I had a client that he had around about 300,000 in super, and he's over 65. So he said to me, look, Dean, why should I keep my money in super? Why should I be paying, I think, $900 in fees a year, and I can just place it in the bank account? Right? And I said to him, look, that's actually a great idea. Let's actually, I'm a facts and figures type of person, right? As you can imagine. So
I'm actually shocked by that statement all by itself.
Right? Tell me about it. So, funny enough, so I sat down with him, I go, okay, look, so if we were to put it in the bank, what are we going to make? So average in the bank now. So you went along with it. Correct. So I go 4%, right? Fantastic. And then we say, okay, well, now we've taken it out of being a tax-free environment into a taxable environment. So give or take.
Oh, because you pay tax when it's in your bank account, don't you?
Correct.
If it earns 18,200.
He was still working too, though.
Right? He was still working too. Story.
Yeah, so he was going to pay a tax. So I think when I took into consideration the interest rate plus the taxes on the 300,000, it was roughly around about $8,500, I'd say, is what he would have made. So I said to him, okay, well, look, let's take a step back. I'm not going to make up any figures. I'm not going to do nothing. Let's go to your statement. Let's look at what your super's done the last 12 months. It returned 10%. So that's 30,000 in income, right? Is there any taxes on that? No, there's no taxes on it, right? Then also as well, with him, so when you look at the difference between the two, it is a no-brainer. Now, he can take that money out and place it in the bank account, but it just simply means he's going to eat into it significantly faster.
Well, another part, if you haven't sort of touched on, inflation, isn't it?
Correct.
So you also got to look at when you're doing lump sum. I also caution my clients, lump sum sounds good, but not only do you also need to factor in inflation. The value of money is going down every year.
Yeah, I was going to say, is there really inflation or is it deflating?
Well, it's inflation. You got your interest on your income needs to be able to keep up with the return, at least to keep your head above water, above inflation levels.
Yeah. So, as you guys guys know I come from an asset finance background. So I'm listening to you talk like that. And I guess mostly because, and this is an analogy I'd probably say that we could use as well, because we mostly are working and partnering with brokers. I'm hearing you talk like that. And all I'm seeing in my head is me sitting with a client talking about interest versus principal, having a car for business use. When is the optimum time that car costs you the least amount and gives you the optimum tax benefit to run that loan for its duration? And then when do you want to exit?
Yes, perfect.
And if you keep it for too long, it's actually costing you money. Even though you think you're drawing down and owning an asset, from a business point of view and tax, it's just costing you money just sitting there. It's the wrong way to structure that loan. So I'm listening to you say that, and that's what's going on in my head, just for visuals for everybody.
Correct.
I'm looking at this whole little, and I see you always, Dean, you're always drawing little houses with stick figures. I'm drawing little graphs with curves, and, it looks like the same amount of scribble that a 2-year-old could do, but it makes sense to people. So I like that. Okay. All right. Well, thank you for that. I'm a bit scared now to talk to you about rollover, because I'm scared what kind of analogy you're going to give me.
Well, I've got to get out of the kitchen though.
I'm thinking of Humpty Dumpty falling off a bridge.
Well, look, with rollovers, it is quite simple in a way, because there's so many super funds available right now. We get bombarded by advertisement on TV, so people really got to understand what it means with rollover. It's investing your money appropriately, looking at the amount of risk you are taking, how much sophistication do you want in with your investment. Some people are happy with just single investment. Some people want more diversification, and also the fees.
And is that rollover in your super or out of your super?
So it could be either or. So within super means choosing different investment options, and outside means I'm with fund A, I want to go to fund B. So this is where an advisor can help you understand what your objectives are. Going European holiday, chasing the summer, and then we plan accordingly. How much drawdown do we need? How do we work on it? And it's really working with the client.
Yeah, and look, one of the things that I've learned in the very short time that I've worked in the crew is I did a really innocent thing a few months, I've been here for, it feels like a few weeks ago, where I had rolled over my super balance to another super fund that has more money in it. And I'm like, guess what, Ricky? I did the right thing. I rolled over my super, but you were like horrified.
Absolutely.
I would have loved to be in that scene.
Well, because people don't understand it, and people do it all the time.
Genuinely, we're educated as, people who are not in your space. We are educated to your optimum thing is to have a single super fund.
Yes.
And maximize that and do that. So I thought, okay, I'm about to start working in a financial planning company. I need to start being smart. So I'm going to go and look for all my lost supers, and I'm going to roll them all into one. And literally I was like a little kid sitting there going, look what I did, Dad. And the look on his face was like, I'm going to ground you for the rest of your life. How dare you do this without permission?
And Mel, you're not the only one. Let me put it that way to you. Clients do it all the time. And in a way, government made it easier where you can go to MyGov and do it. However, what people don't realize is there's also insurances inside your super, which, some of the clients can't get any insurance, and we are maintaining multiple super funds for that reason.
Yeah.
Now, if you just roll it over, you've just lost the insurances.
Yeah. And you know what? Like, I genuinely didn't know. Like, when you said that to me, I was like, oh God, like, help me now.
That was the reaction I had 2 weeks ago. So I got a referral partner that sent me, oh, Jack, these clients have established their self-managed super fund. It's already open. Guess what? I had a chat with the client, said, did you have insurances in your Telstra super fund? Oh, I think we did. And I said to them, what do you think happened to that insurances? Penny dropped.
But the reality is, though, for most of us, and you make a really great point, you sort of think about insurance, right? So, you can't have two health insurance funds. You can only claim on one.
Yes,
so you would assume that on your super, by having multiple supers, that you can't claim. If you've got three super funds, you can't claim on three super funds.
You've done the right thing.
The only thing you can't claim when you've got multiple insurances is actually income protection. But I've got an instance recently where I had a client that her husband passed away, and he had 2 lots of insurances of death cover. and I helped to get a payout of around about 1.5 mil.
Oh, well, you know what? Look, as sad as that is, you've always got to look at silver linings, right?
Yes,
But the silver lining out of my story with you, Ricky, is I don't think I did my rollover properly because the other super fund keeps calling me for more information and I don't take their call just in case I do execute it properly and I end up with one fund. So I will sit down and have a look at it and I will fix it so that I still have 2 super insurance policies. And God willing, I live to 90 and I never need them. But just in case. So that's my takeaway from that. I was like, I thought I was being good for the first time in my life, you know, because I did warn you that I'm not good with this stuff. I work in finance, but I'm financially irresponsible,
I've
as
got
most of
another
us
story
are.
on that, Mel.
Go.
I've got a client where we did the whole rollover, we set everything up, but what they didn't inform the employer that I've got a new super fund. What it meant was the employer still kept sending money to the old super, which meant, guess what? The other super fund opened a new account for them. So
Is that a good thing though, or a bad thing, or it depends?
Well, look, when I say to my client, always my answer is depends because we got to look at your situation.
Yeah.
Could be going back to your point, could be a silver lining where the new account's open, we've got new insurance now at least. But in their situation, ideally we want one account and now we've got another account that's just opened up because they haven't informed the employer.
And then last out of well, I guess, I'm going to use one of your, and actually I'm really surprised at you, Ricky. I'm actually disappointed because when we spoke about rollover, I was thinking of you starting a story about the 3 bears rolling out of bed. So
Well, let's see what Jack comes out with.
you've let me down. Jack and the
Can't be
beans.
the apron or the kitchen.
No, Jack's got to jump onto the golden egg stuff with the whole Jack and the beanstalk kind of thing, right? Guaranteed index pension. So again, explain that.
Guaranteed income.
I feel like I'm getting a wealth of knowledge.
Guaranteed index pension.
Indexed pension.
There's the word guarantee. It's that defined benefit that Dean talked about. It's similar to that. It guarantees you an income or a lifetime pension for a period of time. It's indexed because it goes up with inflation as well. So they calculate that. So pretty much the same as a defined benefit.
So
really.
is it specifically a pension or is it just you structuring your super in a way that you get a defined weekly amount or monthly amount?
Well, it's hard to do
Like
that.
what is the difference?
Well, the difference would be defined benefit. It's pretty much guaranteed, like in a formula.
You can keep using that word guaranteed for me, but I'm still not understanding what you're saying.
Well, guaranteed
Like
index.
it's guaranteed that we're all going to die at one
We
point.
can't really guarantee is a word that we don't use as financial advisors. We can't really guarantee anything. But we can guarantee is index for the rest of the life. It makes sense?
Yeah.
So the return will always be variant on the market.
Well, it's also like one example is defined benefit where you know what you're going to get, but not many people have defined benefit anymore.
Yeah, it's probably better just talking a world that most of us can actually access, right?
But there are investments now available where people can invest money and get guaranteed income for life, and they can also choose indexation so it keeps up. And the thing is, if the inflation goes down, it might also drop at the same time. But there are investments now where we give the company a lump sum money, and then for the rest of your life, you will get a guaranteed index payment.
Yeah.
That doesn't sound like a bad thing.
So like annuities
I'll
and
be
all
very
that
careful
stuff.
with that. I did that with a client of mine.
Yeah.
Again, there are clauses. So essentially, you're giving away your capital.
Yeah, that's right.
So going back to your point, what does my kid get? What do I get if I want to draw a lump sum?
My kids are getting nothing. I'm spending it all.
Well, like my client said, she's going skiing. And like, well, yeah, at your age, skiing. And she goes, no, Ricky, I'm spending kids' inheritance. And I said, that makes sense.
That's a very age inappropriate comment to make.
I'm looking after my client.
So there's options really at the end of the day. So there will be
Okay.
options. Yeah. Just
All
have to tailor make it to the client.
All right. So I guess the takeaway from this particular topic today about what happens to my super when it retires, it's a multitude of things that could potentially happen. So whether you have accumulation where it still sits there and pays tax, but that tax still might be a better option than drawing it down or putting money into your account. Whether you take it as a pension and pay no tax, but then again, are you foregoing a return on investment by having still some of it accumulating? These are all the things that I'm taking out of today. Is that correct to say, guys?
Again, education is the key. Sitting down with an advisor, really understand, nut it down. People tend to think, my accountant's going to do it. But accountants and financial planner, we work together very well. However, I feel accountants are more are sort of backwards looking because the financial year is done now. Let's see what I can do.
I'm married to an accountant. I'm going to tell him you said that.
Well, now you work in financial planning. How good is that?
I'm going to tell my husband you said he's backward.
And financial planners are forward looking. So you are a perfect marriage. You can forward look and Pete can do the
I'm not
taxes.
a financial planner. I'm not a financial
We'll make
planner.
you one.
Thank you. I'm looking forward to that part. I'm looking forward to having an educated conversation. And then I guess what I've taken out today is you don't necessarily need to wait to retirement and do it in one moment. You can transition into this.
Correct.
And that would, I guess, you would probably, in my tiny understanding of today, and you guys have given me so much to think about, which is great because if I can understand it, it means most people can understand it. The standard is not too high, from my part anyway. I guess the optimum goal would be to transition, wouldn't it? Which means that you've set yourself up in a smooth transitional way, that you can ease into it, have a good lifestyle, bits of money coming in, money getting investments and having a return and that continued growth.
It's really going back to that key goal of the lifestyle goal because we built around that. Like that example I used, he wanted to play more golf and fishing.
Yeah.
It could be spending time with grandkids or could be anything really. And we just built around that.
Well, we'll have a different podcast day about lifestyle and we'll talk about what my lifestyle wants to be, and that might need about 2 hours and a whole lot of math and graphs. So, but anyway, does anyone have anything else they want to add for what happens to super when we retire?
Well, Mel, like I said to my client, I'll use your European holiday example. Rome was not built in a day. So
Rome is perfection though. Ask me.
And it takes time to build it.
Yes.
So
Yeah.
the sooner you start, the better. You don't have to wait till retirement to go, I'm going to do something about it. You got to start early. You got to see an advisor early on.
Yeah. And and that's, sorry, go Dean.
So I'll actually add to that point as well. One of the things that I do is whenever I'm providing any advice around superannuation, I like modeling things out for clients to show to them, okay, well, look, this
With all
is
your
where we're
stick
currently
figures.
at. Correct, yeah. But this is where we're currently sitting. And then obviously with making these changes, this is where potentially what things can look like. The clients that actually have the biggest uplift are the clients that are the youngest. So I had a client, and just before I cut you off, but I had a client that was 21, 22. By doing simple things of putting a decent investment structure in place, having a cost-effective fund, it made a difference of an extra around about $800,000 at retirement.
Wow. And you know what? And I'm really glad that you raised that, because on a genuine note, there is a perception around the fact that to have a financial advisor or to get financial planning on a regular reviewed basis, you would need to either A, be wealthy, B, be a high income earner, or C, have an investment portfolio. Because what I've learned from the team is that it could be any of those things. And it could be just, I'm young, I'm going to have a $80,000 salary for the rest of my life potentially, but how can I turn that into my greatest option? And you don't need to be having wealth creation as in investments, because it might not be in your realm of affordability, but it's about just being strategic in, this is my income barriers and how do I optimize that? And then it could also be about wealth creation, or it could be about whatever. But I do love that there is so much to unpack and learn in what we do. And I think there's a lot for us to unpack and really educate people around. You don't have to be wealthy. You don't have to be a high income earner, and you don't need to have an investment portfolio or be self-employed to really look at this and get something really solid out of it. Know that when you are my age or Jack's age, you're set for life. Sorry, Jack.
To add to that is no, thanks for that. In all seriousness, as you probably know, the Ryker team, Ricky, Dean, Ray.
I do know the Ryker team. I work with you. Just so you know.
What I'm saying, you probably noticed that our advice is for different life stages.
I love it.
So we cater from people starting out, first home buyers, first time investors, all the way to people that 60 million to 1 million. So we see that as part of their journey.
Yeah.
Right? So that's how we see it from an advice perspective. Now, other financial advice practices might be different, but we like to be part of that journey. So I think that's very important.
Well, just finishing off for today, one of the things that I did here the other day while we're in the office, and I love that you did that, Dean, is Dean spent a whole session with a client, literally just helping them with their Centrelink. I love that. This, from a values point of view, there is so much to gain from doing that. Exactly. It's not always about, earning money. It's about what can you do for other people as well. And I love that. That's what we do.
Yeah, because sometimes how do you value service and advice? Sometimes it's not monetary. It's that peace of mind that, things help me. I'm okay now.
It's what you give back as well, right?
That's bigger than money.
Yeah, 100%. It's nice to get paid too, but it's also nice to have a full cup and a full heart.
Definitely.
Absolutely. So that when you are in the kitchen in your apron and you're cooking, you have a room full of people to feed. Right. All right, guys. Well, thank you so much. Done.
Awesome.
Thank you.
Thanks.
The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalized advice tailored to your specific situation.
If you enjoy the content we bring you on the Wealth Guide podcast, we'd love for you to subscribe and share with your community. Let's grow this community together and make financial literacy accessible to all.